just in case. Sorry, I forgot to record the last part, but we're gonna get some questions in from the chat and from people that didn't make it today, but they let me know. For the cash your put, I know you typically have a day or two to get the desired premium, but overall is a premium slightly better in the morning of trading compared to the later in the afternoon. I haven't seen any quantifiable evidence of that being dramatic enough to make a difference. There might be some say to that, but I haven't seen it. So
I've seen
Because
it
I
from,
know, like
yeah.
for the 0 day to expiration, obviously you try to sell that in the morning because of the
Yeah.
theta decay. But
exactly.
because of these 35 day to expirations, I didn't know if that morning versus afternoon really mattered that much.
I haven't done actual studies just based on me trading a lot. I haven't seen that. Stocks could move in the middle of the day anyway, and then suddenly the premium might be bigger just because the stock price changed. Like if we're selling a cash put 10% cushion, out of the money, and then the stock drops 2% in the middle of the day after I made a recommendation, that premium will be higher because it's closer to the strike. But that's just based on random luck. It could be lower if the stock jumped up after I sold it. So let's assume the stock stays exactly where it is. Then it's based on the implied volatility of that particular stock. So if the implied volatility shoots up in the middle of the day, which doesn't typically happen that much, then the premium could be worth more with similar risk return profile. It doesn't happen much that I've known. So that's why I wanted to make these alerts where you could get in when I put them in, within 20, 30 minutes, right at the close of that day. But I'm always listing them as option trades for tomorrow. So you have plenty of time to research it overnight if you'd like to. And then as for when to set the position, you could decide to put in the order overnight for the following day and see if it fills right away. It happens a decent amount of times. If the stock jumps a lot up or down the next morning, you might have to adjust the strikes or adjust your premiums. If that ever happens, just let me know in the chat and Discord so we can look back into it. Because sometimes the stock will move 10% overnight before I make the recommendation. So yeah, in those cases, just let me know when that happens and we'll look into it.
Hey, Lance, I'm really new to your service, so far everything's pretty good. I got a few years of doing the cash secured puts and everything, but
Okay.
do you have any, and I haven't had a chance to look over everything on your site yet, but do you have best practices or something on how to track our trades? Any
Yep.
type of simple spreadsheet format, or I don't know what I'm trying to ask, but something like that.
Yes, that was one of the other questions that another person looked at. Let's see, it was, you could see my Google Keep notes of monthly income machine and profiting from iron condors. And should I roll out my workhorse? All right, anyway, that was one. Oh, that was my daily reminder. Tracking positions, someone did ask that. So on the option strategy, I think I put it under ebook strategy channel. I did put a sample spreadsheet that's blank that has most of the information you would want to track. Let me go over what I track, and then you could decide if this is too much for you, or you could even do more, but I don't really see it needed. I have two separate tabs here: spreads, poor man covered calls, which is a type of spread, and then cash group put covered call side. So I like breaking up these because they're fairly different in how you manage them. I'll write what I actually do. I seize iron condor, put credit spread, poor man covered call, right? You want to obviously write the stock name. For my information, I like to see when I sold it and the expiration date. So this was, October 26th, but let's say if it was middle of November and I could maybe get out of it at a profit, I like to quickly see how long was it? Like, was it 2 weeks and then I could make 3%? Okay, maybe I'll get out of it. Or was it 5 weeks and I can make 2%? Maybe it's not worth it anymore.
So you don't always set your stop after you get filled?
For spreads, no. And I'll go over why later. For cash group puts, yes. Let me go over this first though. So date sold, date of expiration, so it's helpful to see what might be coming up. I just like to look at the data over time, so I write the current stock price when I make the order. And then I put the strike prices for Iron Condor, I put the put and the call. It's good to know how much money you're making, so I put the premium. Delta's not really needed to track, but I like to track it just to see, is there a correlation between low deltas and win rate? But it's up to you. It's helpful to put the out, you don't have to do outcome profit loss unless you want to, but I like to track to see how we're doing in the strategy. So I put the outcome, this is buy to close. And then to figure out the profit loss, you take your premium that you collected, subtract the buy to close cost, and that's your profit. And that's pretty much enough, I think. I even did profit percent. I put some notes down, but that's up to you. I don't think you really need it. For the cash secured put covered call side, it's very similar data. Again, I'm looking at premium, outcome, profit loss. Okay, so I did leave a blank one for the spreadsheet if you look in the Discord. There is a wheel calculator. I don't know if any of you guys ever fiddled around with this, but if you put it in, it'll actually calculate your cost basis. The easy way to do cost basis is take your strike price. Let's say you sold a cash secured put at 20, and then you received $40 in premium. Subtract 0.4. Your cost basis will be 1960 because you spent 2,000, you brought in 40. So it's very helpful to write down your cost basis whenever you're assigned a cash secured put. I would pretty much make that mandatory because you don't want to be selling covered calls much lower than your cost basis. That means you're locking in losses, okay? So it's helpful to know what your cost bases are. Does that make sense so far?
Yep.
Another way to think about, so I put that down whenever I do get assigned. Let's look later in the year. I would write the name of the stock. I write CB for cost basis. I write my initial strike that I started the cash secured put at, and then I subtract the premiums that I collect while I'm in that position, either rolling it for a net credit, or if I'm selling covered calls, I'm going to keep making this number bigger. And then you subtract it from the initial price. So RKT I've been in for quite a while now. It's Rocket Mortgage. I started with a cash secured put at 23. I've made 158 in premium off it so far. So right now my current cost basis is 2142. And that's good to look at whenever I want to sell a new covered call. I'm probably going to want to sell a covered call around 2122. If you didn't write that down though, you may not be aware what your cost basis is, and you might accidentally sell a covered call at say 15. If that gets assigned, you just took a pretty big loss in that position because you had to buy it for 23 and you sold it at 15, right? So that's I think it's very important right now, your cost basis, whenever you get assigned on a position.
Yeah, I've forgot to do that a few times, and I'm finding myself going back in my history trying to calculate it.
This takes me literally 30 seconds to a minute to write this all out. It takes me longer to write it on the Discord, what I actually did, than this, because I'm so used to writing these out already. So it doesn't take a lot of time. So I would recommend doing something at least relatively straightforward on it. What was your other question you mentioned, I think?
I don't know if I had another one.
I think I said I would answer.
I'm just glad this isn't chemistry.
Chemistry is easier than this sometimes. But this is all based on probabilities anyway.
Yeah.
Anyone else in the group have any other questions, or I'll answer the ones for the others that posted it? There's not much else actually. I covered most of it already. Position sizing, again, get about 10 positions equal weight or close to equal weight. You don't have to be exactly 10%. And it's hard to do that sometimes. Tracking positions already covered. Cost basis. Yeah, again, subtract your premium received from your initial strikes. That'll get you your cost basis. In general, you don't want to sell covered calls below your cost basis, Because then if that gets hit, you just locked in a loss. Someone asked, what's a poor man covered call and spread? Any of you guys here in the channel ever did a poor man covered call yet? So it's a little diagonal.
Nope.
I haven't done one, but I've heard about them and watched some videos on them, so haven't
Okay.
done one yet.
I'll mention briefly what to look for those. In general, you want to look at about a year out. And I like a little over a year because you're gonna be getting long-term capital gains, which is a lower tax rate. So something to consider there. All the other trades we're doing, unfortunately, short-term capital gains, which is at your income tax. So there's not much you could do about that. Uncle Sam always wins these battles no matter what. But in this leap, you could buy one a little over a year. So if you buy the January 2023 option, it's over a year. If you happen to hold it for a year and a day, you get a better tax treatment. So that's something to consider. So what I like to look at are, you want to be more bullish on a certain stock compared to others. So if you think a stock's going to be going up in a short period of time, you could use leaps to leverage your money quite a bit better than just buying shares. Typically, you want to look at a leap with a delta 0.75 to 0.9 or so. It's a pretty big range. I like around 0.8, 0.85. So I did buy a SoFi leap a few months ago at a 10 strike price. The current stock price is 17.20. We want to be buying leaps pretty far in the money in general because they're safer and they cost less extrinsic value. You don't have to really worry too much about that. But the quick way to look at that, right now, SoFi, the 10 strike costs, let's say about $900. Let's see, midpoint of these. So 10 plus 9 is $19 total. And SoFi right now is at 17.20. So it's costing us a little bit of money when you add up the strike plus the call price. However, you could now sell covered calls off this position and you didn't have to buy 100 shares of stock. Buying 100
That
shares-
right there is what I have a hard time wrapping my head around, where you
Okay.
can buy a call and sell at the same time without actually owning it. Are you using
Yes.
some type of margin, or is that?
You're not actually directly using margin for it. You do need to be able to sell spreads though, for your brokers to allow it. And my Roth IRA, I don't even bother with this. So double check your option level in your brokerage and see if you could sell spreads. If you could sell credit spreads, you could do this. Essentially what the brokerage is saying, if they approve you for selling spreads and buying spreads, is this is mimicking owning 100 shares of stock because I own a call option that's like owning 100 shares, even though I'm not directly owning it because I'm buying a call. Does that make sense?
Yeah, it does. So what would be worst case scenario in something like this? If a year comes around and it's at $9,
Yep.
I'm gonna have to buy it at, just make sure I have the money in there, or
You
I
already
guess I could-
you already buy this to start the position. You would
Okay.
just lose all that money, unfortunately. So if you wanted to get into it today or tomorrow, you could buy this option for about $900. And then you could start selling covered calls off it. So 900 would come out of your brokerage right away. And yes, that is the worst case scenario. If it goes below your strike of 10, if it goes to 9, you would lose this whole amount if you held it to expiration, unfortunately. At least you're making some money on the covered calls though.
Right, so you're getting premium, correct?
Yes.
Okay.
Now,
Yep.
if you think about it, let's say you bought 100 shares at 17.20 and then it goes down to 9, you still lost like $800, right? Here, we're losing about $900. You're losing slightly more, but you could still sell covered calls and use less money to do so by buying a leap instead of buying 100 shares. So that's one of the main benefits to it.
Mhm.
For a low price stock like SoFi, it's probably just worth buying 100 shares, selling covered calls right away. And you could
Right.
also, you could always do that. You don't have to start on the cash or put side. If you think a stock is going to be good and bullish, you could buy stock, sell covered calls quite a bit higher than that. taken some premium. And then if that gets assigned, you just made some big capital gain anyway.
But I guess if you wanted to do it like on Tesla or something, a
Yeah.
higher end stock, this would make more sense, I think.
Exactly. Tesla's gonna be expensive anyway you look at it. Like you're still gonna need 10 grand minimum on it. So if I was doing, it's gonna be a lot. If you were gonna buy Tesla around an 800 strike compared to 1144, it's still gonna cost you 46 grand,
Mhm.
47 grand, but it's not gonna cost you 114 grand. It's a third of the price about to sell covered calls off it.
I know. I mean, I hear about these guys making a living just on Tesla. It's
Yeah.
nuts.
Apple's a decent one. It's very good stock in general, right? 165.30 would mean $16,530 to buy 100 shares. Quite a bit of money, but you could buy a leap around 125, 130 sounds reasonable. For again, about a third of the price, about 47.50 or so. And then sell covered calls off it. So that's a reason one. That's one of my goals. Start selling leaps on Apple and make sure it's nowhere close to my, 10% per position.
Do you have a section in your Discord that do these or not
Yes.
yet?
Yes,
Okay,
if you look in the Discord channel, it says PMCC.
got
That's the
it.
Pullman
Okay.
covered call part. I don't
Yeah.
have too many of those right now. I have SoFi, I have Palantir, PLTR. And one more I added today on Fubu. I actually said I'm doing something new on that. So I don't want to go over that part, but I did. Palantir, I'm down quite a bit on it. I bought it for $910. It's currently worth $500. So it's a pretty big drop, but I'm selling covered calls off it. See, January 23rd, I bought it at 20. Current price is down to 20 almost. When I initially made this position, it was around 24, 25, I think. So that is one of the detriments to these. Your leap could be worth a lot less. However, I'm selling a covered call off it 3 weeks later, 25 strike. You typically want a strike price quite a bit higher than the current price because you don't want to lose your covered call part, which means you'd lose the whole position. And then that I made $30 in about 4 weeks. So I figure if I sell covered calls pretty safely off this, I can lower my cost basis of the leap. And then over time, again, I'm bullish on this. I still have 416 days. I got over a year for this to bounce back up. So I'm not worried about it yet. Typically, you might want to get out of a leap with around 60 days left because then your theta decay is going against you on that bought call a lot. Essentially, we're using a low theta as our benefit to buying a leap because it's cheaper to buy a leap than buying 100 shares. And it doesn't decay very much when it's so far out in time. It's out a year.
And these would only, obviously, there's no such thing as a poor man's covered put, is there?
There is. There is.
Oh, there is. Okay.
You could do
All
the
right.
same strategy with puts. I don't happen to do that, but you could.
Right. Okay.
Look at SPY. I was looking at this last night before I fell asleep because this is all I do for a living, right? I literally was like looking at this on my iPad. I'm like, it's almost free, quote unquote. SPY's at 455. You could sell the January 2023. Let's say we're buying a leap here. We could mimic owning SPY. Let's say 300 strike price. It's 162 or so midpoint. 300 plus 162 is 462. That's the overall cost for the leap, right? Right now, it's at 455. That's very little, if anything, as you look at it as a percentage. What is that, 2%? In order to be able to sell leaps on SPY for a third of the cost? Pretty amazing, honestly, I think.
So what's the guideline once you bought the leap? How often do you sell a call?
I typically sell a call every month. I don't want to have to deal with it every week on managing all that. You could if you want, but I usually go a month out. And then I'm going to go at a delta around 0.1 to 0.2 in most cases. What I typically look at is the difference of your deltas. So if I bought a SPY leap for 0.9, I might sell a 0.2, 0.3 delta. You want the difference of your deltas to be pretty big because you don't want to lose your covered call. Is there more in the chat? Australia. Okay, cool. Any other questions from the group? Because I answered everything else from the others.
I'm good.
Keith Jackson, anything else I could help out with? Or Jason?
No, I'm good. Jason left, I guess. No, he's here still. So, but on that short, when you have the long call, the poor man cover call, you have the long call, the short call. If it gets close to being in the money, you could always close it out early, buy it to
Yes.
close it, right?
I did that with SoFi when SoFi ran up. I actually had to close it at a little loss. It was like a $10, $15 loss because I wanted to keep my leap and just keep. The leap went up faster than the covered call does. You want
There's
to be bullish on the stock. When you're doing a leap, you need the stock to actually go up in price over time.
There's a really small chance that they would exercise early on you, but that's
Yes.
pretty small, right?
On the sold covered call, if it's way in the money, possibly.
Okay.
It's pretty unlikely. The only time that happens is if there's a dividend coming up and they might want to exercise the option early to collect the dividend. That's only happened to me once in about 4 years.
Yeah.
It's very rare. I wouldn't worry about it. The thing to worry about though, if your covered call for your leap goes in the money, say you sell a covered call at 25 and it's at 28, 29, it's probably too late to roll it at that point. You probably just have to buy it back at a slight loss. Typically, you want to try to manage it if it gets to the covered call strike. So once it hits 25, if there's say 2 weeks left, consider rolling then or buying to close it pretty quick. Because as it goes past 25, you could start losing money because your leap will not go up as fast as the covered call would. It could happen. The way that I set it up, 10 more minutes. The way I set it up is if you have a really big difference in your deltas, that's very rare to happen. Because I don't want that situation to come up a lot.
All right. Thank you.
All right, Russell, anything else?
No, I'm good.
All right, and Jason, good?
Yeah, I'm pretty good. I didn't know if you guys had any success stories of some of your other students as far as have they replaced any part of their income yet or what their goals are or anything like that with the service?
We haven't heard, Russell, that's something to mention. We haven't talked much about long-term goals of our members.
Hmm.
A good thing to ask about. Because long-term plays here obviously should matter based on these monthly positions that we do, right? Was it Mees, I think? He did one, I think. I think he mentioned how he was up a certain percent a few months ago. My personal goal is to get 2 to 4% a month. Because I figure if you can get at least 2% a month, every month consistently, you're going to beat out SPY. And that's usually a benchmark for most hedge funds and alerts anyway. So I figure if you get 2% a month, I'm still in the growth phase. I'm not retiring anytime soon. Just trying to build up the accounts as much as I can, reasonably and conservatively. I don't want to go for strikes that are really high deltas that are possibly getting a sign here. But if you look through the spreads that I do, they're typically going to make 4 to 8% a month. And I know not all of them will work. So if 80% work, the other 10% you're still good on, right? You still average at least 2 to 4% from that. It's all a numbers game in the end. Not every position will work out. We're at the mercy of the market, right? You don't know what's going to happen with the market, but we want to be in very high probability, very far out of the money positions where the odds of that happening are very unlikely. I was also thinking with the Iron Condor I did today on IWM, it was, the put was so far away. IWM right now is at 220 and we're selling a put at 165. If IWM goes down to 165, we're going to lose about 6-7% on that trade. But IWM went down like triple that. So if you were just holding IWM and it dropped that much, you'd be down a lot more than just the initial position we started with, right? Another thing to
Yeah.
consider, sometimes these iron condors that are very far out in time, month out, 45 days, they could be safer in a market tank than holding the stock. Because you're only in it once, right? And it's a numbers game. If you happen to be wrong once in that 1 month, but if you look at the very long term, many, many hundreds of trades, as long as your probability win rate's at a good rate, 80% or higher, you're at a
Yeah.
positive expectancy, and that's what we're looking for.
Yeah. And I guess like the question about the subscribers and stuff, the service has only been around for not very long, right? We only just started
Four,
this.
5 months, yeah.
Right. And we didn't push it at all, really. So we've really these last few weeks have seen the membership's doubled or something, isn't it?
Yeah.
It's ridiculous. So there's not a lot of people to talk to, but from my experience of following Lance, you can replicate his trades. So if you look back at his track record, you can pretty much, it's not like one of these services where you're chasing crazy stocks or whatever. So I use Lance as the benchmark for everything, which is valid in this particular circumstance because of the nature of the type of trades.
Right. I was about to tell Keith he should read my ebook on how to teach your kids how to invest, because I saw his daughter there.
I think he just ran away.
Yeah, he ran away. I put a book on how to teach my daughter. I have a daughter almost the same age. And I'm teaching I don't teach options yet, but I'm teaching just buy this stock. Look at it. It's gonna go up in 20 years.
Yeah.
How often are the Zoom meetings? This is our first one that was just private for the group.
Yeah, normally we're broadcasting on YouTube or something.
Yeah, we usually broadcast it to the general population, so try to get new people interested in the thing, which I don't mind doing. We should do that about once a month or every few weeks, but we could do one of these every month too, if you want. It depends on what the members want on it.
Yeah, this has been great. I feel
Yeah.
kind of like
Yeah.
this is the first one. So this was very informative. Appreciate it very much. And looking forward to the service. I kind of took your deal on the whole Black Friday thing. So looking forward to it. So appreciate you. You're
Yeah, thanks,
great
man.
teacher, got a teacher's heart, and hopefully we can make some money here.
Yep, sounds good. Hey, DM me at any time on your Discord, okay?
I will. Absolutely.
Yep, no questions too silly. That's why I'm here to help.
Awesome.
All right,
Awesome.
sounds good,
Well, yeah.
guys.
Yeah, thanks again, Lance. That was awesome.
All right, guys. We'll talk to you guys later. Have a good night.
All right, catch you later. Cheers. Thanks.